Hello and welcome to Moneycontrol. You have tuned into IPO Watch and I'm your host Nickey Mirchandani. Well, today we are here to talk about Suraj Estate Developers 400 crore IPO, which will open up for subscription on December 18th. Of course, proceeds will be used towards the payment of debt availed by the company and its subsidiaries, of course. But to know more about the financials, company's strategy and the outlook going forward, we're being joined by the CMD Rajan Thomas and the Director Rahul Thomas here. Afternoon there, gentlemen.
Thank you. Thanks for having us here in your show.
Well, pleasure is all ours. Let's straight up ask about your business model. How does this work? What are your kind of clients that you're catering to, and much of the dependence on a geography which is South Central Mumbai region? Do you intend to diversify? So that's a bunch of questions right at the first go.
To start with, our company started way back in 1986, and it started from the island city of Mumbai, that is Mime. And then as we went along, we got a number of opportunities to develop in the same area, Mime, Dadar, Prabha Devi, South Central Mumbai. So over our journey, we have done 42 sites, and as we speak today, we have 13 ongoing sites and 16 more sites to come, which are sitting on our books, and we have acquired those sites. We will take it up as we complete the ongoing sites. As far as the geography is concerned, since traditionally we have purchased these properties, it's not that we are only going to stick here. We are looking for opportunities in other parts of Greater Mumbai as well, and also anywhere else for that matter going forward, as long as there's good profitability seen in the horizon.
When you say, please go ahead, gentlemen.
In terms of also the typology of partners we're making, we have mainly here to segment our business into three categories. We do value luxury, which is 1 and 2 BHK homes in very prime locations that's catering to a larger mass audience. And of course, then we have the luxury projects where we're catering to a 3 and a 4 BHK audience, and then of course our commercial segment, which we are always doing. So one leg is always in commercial.
Sure. I just want to understand, you said that now you're in the process of evaluating attractive growth opportunities, and that mostly will be in Greater Mumbai. Tell us more about it. How many projects are you going to come up with at Greater Mumbai, and from South Bombay to Greater Mumbai, what's the pocket that you're looking at? Give us more details, fill us in.
Today most of our sites, all of our sites are between Mime West and Prabha Devi, but we have acquired lands in Bandra also. So our next trajectory will be Bandra and the suburbs, and then we have many other proposals that have come from Thane and other places. But as we said, each proposal has to be very carefully evaluated for the returns, because now when we go public, it's all about giving continuous returns to our investors.
Sure. I would just want to understand, is it just Mumbai that now you're going to be looking at, or you're going to go beyond the city or beyond the state for that matter? What are your plans of expansion, organically versus inorganically, both?
Yeah, today we have something like 16 properties sitting with us as we have acquired. This is a pipeline for another 4 to 5 years minimum. So we have a pipeline of 5 years. But as we go along, we have a lot of opportunities coming in for the redevelopment of properties belonging to societies, which are about 30 years and beyond and older. So those societies are all over Greater Mumbai. So they have also a fantastic potential for development. Also, we also are on the lookout for vacant lands, 1 or 2, for exploiting for commercial, buildings and things like that.
So any particular state? Sure, you've laid out your plan.
Today it will be Greater Mumbai. We have enough on the plate for Greater Mumbai, as I said, a pipeline of 4-5 years. But there is no restriction whatsoever. We are open to look at other properties going forward. But first priority would be to exploit all the properties which we have already committed.
Sure. So Bombay and Greater Bombay remains your preference region,
Absolutely,
and you don't intend to diversify beyond that, right?
As of now,
that's not there on the plate. But one can never say no to this kind of situation.
Any further plans, if you have some stress assets to be considered or consolidation at play? attractive? Would you consider the inorganic expansion in this as well to grow your market share from the present 16%?
If we get some vacant lands, as I told you, if we get some vacant lands, we are okay to buy those companies up, or merge those companies with us, or enter into development agreements with those companies. So this is all as per the situation that would arise as we go along for acquisition of lands.
So anything right now that you've perhaps vetting or evaluating where there could be a potential?
Yeah, we have acquired already a very good parcel of land at Mime West on the prime arterial Tulsi Pipe Road, where we are coming up with a commercial building of 1 lakh square feet. The plans are already approved, and we will be launching in the next quarter.
Oh, and when is that going to reflect into your financials? Usually after the commencement. Commencement will happen in the next quarter. When it will start reflecting on your financials?
It will happen from next year onwards. So financial year 24-25 is where it will start reflecting in financials.
So typically what we do is we also prefer to do a build to suit kind of a sale to 1 or 2 anchor clients, and we are in the process of discussion with 1 or 2 good top clients. So if they were to buy, our sale is established, and we'll have good realization coming in the next 18 months.
What kind of realization are you looking from this project also?
The top line of this project could be, in that area. In that area is about 45,000 is the price going in that location, and we have about 1 lakh square feet to sell. So there's good top line.
Any kind of number that you can peg to this one? What % would it contribute to your revenue in FY25, if I'm just supposed to put it that way?
It's difficult to give you an exact number, but as
I'm sure since now you're going to commence your project in another quarter, which means.
As I told you, the top line would be roughly the price range in that area. That's on Tulsi Pipe Road is between 40 to 50,000. So I mean, you can do the math. It's approximately around 400 crores.
Okay, 400, 500 crores.
Plus, we are going to launch 1 more residential site on the area of Bandra, which also has got very good potential of something like in the first phase itself about approximately 40 to 50,000 square feet. And then going forward, another 1 lakh square feet.
Sure. I would also want to understand your market share currently is at 16%, right? How much do you intend to grow that by, say, for example, FY25? What's your target? What's your projection that you're looking at?
We'd like to actually more than increase it. We are looking at, of course, other geographies like that said. So Bandra would be a market, so that was not covered in our industry section of the RHP. So we'd like to have some market share in new areas like Bandra, where we, like that said, we have the first phase of 50,000 and the next phase of 1 lakh. So I think that would be the next geography which we would like to establish a market share.
Okay, so from South Bombay, you go to Bandra and also Greater Bombay. Let's talk about revenue growth profile in that case, right? You've maintained a 12-13% of growth at least in 2022 and 2023. With the expansion that you have, both in Bandra and Greater Bombay, what kind of incremental revenue growth one can expect after these projects perhaps are identified and commissioned, and by which year?
So in terms of rather than revenue, I would talk about pre-sales, because in real estate pre-sales is what's important. So we did approximately 360 odd crores in FY 22-23 and 21-22, and in terms of 22-23 we did 635 crores. So there's a huge jump from pre-sale numbers. We expect to continue that trajectory for this year as well. So good growth is what we're looking at for March 24.
So for 24, the numbers will remain 12-13%, and your focus essentially in Bandra will start. You'll start diversifying. You would like to start diversifying since which year? Will that be FY25? And also for your Greater Bombay, what's going to be the target looking like?
So March 24 is what we are planning to. Before March 24 is what we plan to launch the first phase. Of course, the second phase, which is a larger development of almost an acre, would be coming in the second half. So basically next year, FY 24-25.
So 24-25 is for Greater Bombay, if I'm not wrong.
Yeah. No, actually, Greater Bombay, we are not tied up anything as we speak. We have a lot of opportunities coming our way and a lot of offers coming our way. So we are hopeful, but since we have already have so many on our plate, we like to also concentrate on execution and handling of existing sites.
And bringing the cash flows from our existing projects.
That's also very important than just organically or inorganically expanding. We have to deliver because we have rarer act sitting there where we have to adhere to our dates as well.
So both of these expansion in these new geographies, apparently, if I may just put up that way, new areas rather, would happen through internal accruals, or again there is going to be a debt which is going to be raised for this?
So as we speak, as we told you, we have some properties like something like 16 more which you have acquired. So there won't be any further investment for lands. The investment will be to kick off these sites. The initial investment involved to getting the approvals, statutory payments to BMC, etc.,
and construction
and temporary relocation of tenants, giving them temporary accommodation till the site is completed, and then to rehabilitate them back. That's one part of our work. And going forward, also simultaneously we need money to kickstart the sale component as well, which will give you the exact revenue.
So idea is to generate, we already have a good surplus coming from our ongoing sites, so that will be deployed to our upcoming projects. And also we have a huge interest saving from the repayment of the loan, which is the objects of the issue. So I think both this will be enough to take care of at least the incremental cost of construction and approvals.
Sure. I'd also want to understand where is the focus going to be? Would that be value versus pricing now? And also the number that we're looking at, 16% of the market share. By FY25, how much would that number increase to?
The first part is in our portfolio, it constitutes 60% of value luxury and 25 to 30% of luxury and 10 to 15% of commercial projects. That's been the mix that has worked best for us, even post-COVID, pre-COVID. So from our past experience and the long history that we have, we would like to be cautious and continue with the same product mix. And coming back to the share, we will incrementally increase our share by either
maintaining our current share and also look at new geographies where we can add
and taking larger projects which can add up to our bottom line.
Sure. Gentlemen, also tell me about the status of your 16 upcoming projects which require BMC's approval. That is within the 1 year of request that you place that these approvals need to come through, which was placed in October 31, 2023. That's just been a month. How focused are you and confident that you get approval for all of these 16 upcoming projects?
So I think most of the upcoming projects already have an IOD, so we are almost ready to go in those lands. Of course, maybe 2-3 of the upcoming may not have an IOD, but we're already ready in the design stage. So I think we'll be submitting that soon. So I think at least maximum portion of the upcoming projects have a very clear visibility of immediate cash flows coming up.
Sure. Also help us understand the difference between your margin profile. The company sits with a margin of 49% versus 6 to 20% seen by that of Sunteck Realty, Keystone Realty and Shriram Properties. What explains this kind of margin that we are witnessing? What different is the company doing to capture this margin? Is it just that you are catering to South Bombay markets because of which the margin profile is a little higher as compared to that of its peers?
Okay, basically, these margins are coming because of our historical purchases of land at very low value. They have been purchased at very low values over, say, 15-20 years. Number one. Number two, our area of operations itself prices are pretty good, like, compared to the suburbs. Our rates are also pretty good, 40, 45,000, 42,000, conservatively speaking. And
also because on account of the redevelopment of such properties under 33(7),
FSI index is higher.
And we do not buy the land at obviously the market price, so we get a discounted land cost. I think that is the area where we make up our margins. And our expertise over the last 37 years to redevelop and rehouse tenants. And that's where our value addition comes on a land which is a private land belonging where tenants are today existing. And also under 33(7), under the DCPR, we get certain concessions by the BMC since we are rehousing tenants. I think both these factors also add to the margins.
What's your average sales realization for FY23, and how much do you intend to increase that by FY24? What could be the number? Is it more going to be value versus volume? Where is the focus going to be?
Both of it actually, ma'am. Be a mix of both. For instance, we need to also increase our footprint in terms of value and also reduce construction costs. And we are also, as we said, we are going to save substantial interest, which will add to our bottom line. So that is also going to help us a lot.
How much was your average sales realization in FY23, gentlemen, and how much do you intend to increase that by in FY24?
So as we said, last year FY23 we did 635 crores pre-sales with a revenue recognized of approximately 305 crores and EBITDA of 151.
Okay, so how much do you intend to have an increase, at least in terms of your realization figure?
If you look at our the trajectory of our growth for the last 2-3 years, we are sure and confident that we'll maintain the same trajectory going forward.
Okay, so you expect to sustain that trajectory and also the margins profile, right? You think a 50% margin is still doable in FY24 also because it's way above than what your counterparts are looking at.
Yeah, as I told you, that is because of our low acquisition costs, which was done historically. These properties have got that kind of returns. Going forward, we will try our best to maintain that kind of a margin.
Yeah, but if you're looking at something like a Bandra, I'm sure you will have to acquire in land which is going to be at a higher price, and by virtue of that, you might just see a margin dip with that, right?
A large part of our construction, our cost is also towards finance cost. As you know, in every project, finance cost is quite high. So that's where one area of minimization will happen. And then, as we said, we have got a pipeline of 5 years, which are already lands which are acquired by us historically. So whatever profits come from there is bound to be more.
Just to clarify, ma'am, we already have acquired the land parcel on Mumbai, so that is also at historical cost.
Well, point well taken. So talk about your order book right now. How many ongoing projects, how many upcoming projects, how many completed projects, how many of them will be reflecting in your FY25? So talk us more about those projects.
So ongoing projects, we have 13 of them as we speak. The completed projects were 42 across our company's life cycle past. And then going forward, we have 16 more sites to be exploited. And notwithstanding the same, we have a number of offers coming from society, plots as we call it, owners of society, cooperative societies who want their buildings to be redeveloped because they are all more than 30 years old and they can't. It's not economic to repair them. And further, they're getting better incentives also. If you redevelop it, they get 30%, 40% more area. So such offers are also on the table for us. So we see a great pipeline going forward. We don't see any dearth of our raw material, that's land, and the market also is in a very good cycle. We expect the same to continue for another 4 to 5 years at least.
So do you intend to operate in the premium segment? Do you intend to perhaps even look at affordable at some point of time? What's your focus area going to be like?
So basically, as said earlier, we would like to focus on value luxury as 60% of our upcoming inventory because that has done all throughout, done well pre-COVID and post-COVID. Luxury is also something which we will be focusing on. For example, in Bandra, that would be in the luxury profile. And in terms of commercial, we will always want to do commercial because there's a huge uptake in commercial as well. So I think this would be our mix, but mainly value luxury in terms of 60%.
So commercial is how much percent of your overall order book right now?
About 10 to 15 as of now.
So how much do you intend to scale that up by FY25?
I think around 20 to 25% at least.
So commercially, margins are more accretive as compared to that of your luxury segment?
They are different in their own ways. Luxury also is doing very well today. The margins are good. Commercial is you get big ticket sales because of the demand today by corporates. So They have their own, own attractions. So we'll have a healthy mix of all of these three, all the three.
Okay, that is one you said was commercial, second one you said was luxury, and what was the third segment that you mentioned, gentlemen?
Value, 1 and 2 BHK.
One in compact, 1 and 2 bedroom flats, which are sort of a budget flats for the market of Mumbai.
So,
city.
of the three, which one, gentlemen, you think is more margin accretive? Is it commercial, of course?
No, actually, luxury gives us the maximum returns.
What percent difference, if I may ask?
See, the price difference will be something like 30% difference, 25% at least, between commercial.
Then why diversify more into commercial when luxury is giving you more incremental?
No, we will not diversify more. We are going to keep that mix at 15% max of our portfolio.
Because, Rahulji just told me that you're going to be perhaps looking from 15 to 25% in the next 2 years.
Not of the mix, 25% accretion on the existing areas that we are doing.
Okay, so a growth profile.
Which is 15%, and if you have another 25%, maybe it will go up to 18, 19, 20%.
All right. Okay, gentlemen, the last question that I have is debt to equity ratio. It's come down to 6.95 for 3 months ended June 30, 2023. But it stood at a considerable level of around 8.31 in FY23. What is post this issue? Of course, what's your debt to equity will look like, because it's also an issue to essentially bring down your debt. So, how much will your debt to equity ratio look like? And what's your comfort level? Please go ahead.
Yeah, very good question. Basically, we will be paying off 285 crores from this issue towards high cost debt. Full repayment of high cost debt. We have a second strategy to also replace high cost debt with low cost debt wherever construction is on. And our debt equity ratio that will be comfortable will be roughly between 0.5 and 1 of the paid up capital.
So that will be achievable by when?
Very soon. As soon as this issue is done, we should be paying off about 285 crores, and our debt that will be left will be approximately
from ongoing side will
270 crores against the paid up capital of 500 crores. So we are somewhere near 0.5, 0.6.
All right, gentlemen, we'll just leave it at that. And thank you so much for taking out the time and having this conversation with us, and wishing you all the luck for your subscription.
We need that, and thanks for having us on your studio.
Pleasure is all ours. Thank you. Right, that was the management of this real estate developer, pretty much aggressive and pretty much focused when it comes to the geographical areas. More dynamics need to be worked out, but this is all that we have in this edition. Stay tuned in for more.